We're in a market defined by intense velocity. Valuations are stretched, AI dominates headlines, and algorithms trade millions of shares in fractions of a second. Contrast that frenzy with what the world's most famous value investor is actually doing. Right now, Berkshire Hathaway is a massive net seller of stocks. This chart compares the rising S&P 500 against Berkshire Hathaway's balance sheet. While the broader market climbs, Warren Buffett has quietly stockpiled a record-breaking cash reserve of over $370 billion. That massive pile of cash forces a hard question. Is a century-old investing framework failing to keep up with modern markets? Or is the Oracle of Omaha actively shielding his portfolio from a looming correction? Reliable compounding requires a rigorous system of business evaluation rather than a high-speed trading algorithm. Warren Buffett and his late partner Charlie Munger spent decades refining this methodology, building an enterprise designed to endure market cycles rather than chase them. We are going to deconstruct the 3 pillars of their investment thesis. We will look at the actual effort required to execute them and examine 3 specific stocks that survive their tests. Because chasing those legendary returns requires a very honest look at the intense analytical work you have to put in versus the probable outcome for your portfolio. The first constraint is purely qualitative. You must restrict your investments to your circle of competence. That means only buying businesses where you can accurately predict the competitive landscape 10 or 20 years out. If you cannot predict how technology will impact an industry, you stay out. Kodak had massive margins in the 90s, and Blockbuster dominated entertainment, but their business models were fragile. Staying within your circle of competence protects you from that kind of permanent capital loss. This Venn diagram maps the economic moat. You look for the intersection of businesses you understand and those with structural advantages fending off competition. Volatile tech falls outside this overlap, while predictable consumer staples sit inside it. The psychological trade-off here is steep. Adhering to this discipline means you will routinely miss out on explosive, hyper-growth market trends. During a bull market, watching other people get rich quickly feels punishing. Coca-Cola is the classic example of staying inside that circle of competence and identifying a massive moat. The company generates highly predictable cash flow from a brand that spans the globe. There is virtually zero risk that a new piece of software will make people stop drinking Coke. Shrinking your investment universe creates a defense against devastating financial mistakes. Once a business passes that qualitative test, you hit the second pillar, a strict, unforgiving set of quantitative filters. Standard accounting metrics like earnings per share can be manipulated. You have to strip those away and manually calculate owner's earnings to uncover the true cash a business generates after capital expenditures. This scorecard outlines the thresholds. You need a return on equity above 20% for a decade and a debt-to-equity ratio under 0.5. Next, the $1 retained earnings test. For every retained dollar, management must create $1 of market value. These filters ruthlessly eliminate capital-heavy, inefficient businesses. What survives is a tiny fraction of elite capital allocators that can compound wealth internally. The math eliminates roughly 95% of the stock market. You are forced into a highly concentrated portfolio, what Buffett calls a 20-slot punch card for your entire life, which requires immense patience. Moody's is one of the rare stocks that easily passes these tests. They operate a virtual duopoly in credit ratings. The business requires very little capital to grow, which translates into massive profit margins and a highly consistent return on equity. Concentrated value investing requires the patience to ignore hundreds of average companies while waiting for the top 5% of elite compounders. The final pillar demands an absolute separation between a stock's current market price and its true intrinsic value. You run conservative discounted cash flow models to figure out exactly what the business is worth based on future cash generation. This graph plots intrinsic value as a steady upward slope, while the market price oscillates wildly around it. You refuse to buy until the stock is priced significantly below its true worth. That gap is your margin of safety. The concept originates with Benjamin Graham, Buffett's mentor, and it remains the intellectual foundation of Berkshire Hathaway's strategy today. Buying at a deep discount creates a financial cushion. If your growth forecasts are slightly off, or if a macroeconomic shock hits, that discount protects your principal. The psychological toll of this rule is brutal. You might sit on billions in cash for years, enduring intense boredom and criticism, just waiting for a market crash to deploy your capital. Apple is a perfect illustration of how Buffett executes a margin of safety play. For decades, he ignored Apple because early-stage tech was too unpredictable. He only paid attention when it transitioned into a consumer staple, backed by immense brand loyalty and high switching costs. Even then, he waited. He only initiated a massive position in 2016 when Apple's price-to-earnings multiple dropped to a deep discount, securing a huge margin of safety before committing his capital. Calculating a margin of safety identifies the price, but waiting for the market to hit that price tests an investor's emotional discipline. Buffett's method is mathematically simple, but psychologically grueling. The difficulty lies in holding a concentrated position through a 40% market crash without panicking, long after the initial stock selection is done. This decision tree maps your time and temperament to the correct strategic path. First is the optimizer. If you possess emotional control, enjoy reading annual reports, and can stomach a concentrated portfolio, these tests will serve you well. Next is the action biased. If you feel the need to trade frequently, chase hype, or cannot tolerate holding cash for years, this active strategy will break you. You will end up buying late and selling early. Finally, the time poor. Analyzing true owner's earnings requires immense active effort. If you simply cannot sustain that level of work, you need a different approach. Berkshire Hathaway itself is built to endure, ensuring its rigorous culture of value investing will persist under the transition to Greg Abel and future leadership. But Buffett's ultimate advice for the average investor is clear. If you cannot dedicate the intense analytical input required, your statistically superior choice is to relentlessly dollar-cost average into an S&P 500 index fund. The math of compounding accelerates best when investors stop interfering, step back, and allow productive businesses to generate returns over decades.